In this video, I will explain how capital gain is different from other income, why is it important to understand this difference, and how will it impact your tax situation. Hi, I'm Jamal Abbasi from Source Accounting Professional Corporation, your Canadian tax partner. Before we go into technical detail, what is capital gain? Let's try to understand why is it important to differentiate between capital gain and business income or any other income. And reason is very simple. If you earn a business income or employment income or rental income, this all income will be included with full amount in your taxable income. Let's say you earn $100 of rental income or business income, $100 will be included in your taxable income. But if you earn $100 of capital gain, the $100 will not be included in your taxable income, but only, let's say, 50% of this will be included in your taxable income, and this is called inclusion rate. So now that you understand that capital gain is partly included in your taxable income, which is called inclusion rate. Before June 25 of this year, the inclusion rate was 50% whether you are individual, corporation or trust. Rules have changed for inclusion rate since the June 25 of 24. If you are individual, first 250,000 of capital gain will still be included 50% in your taxable income. If you earn capital gain of more than 250,000, the additional amount will be included at the rate of 2/3 in your taxable income. For corporation and trust, the inclusion rate is 2/3 from the $1. Now that we know how capital gain is treated in tax, let's try to understand what is capital gain. This I will try to explain with a very simple example of a coffee shop. The business of coffee shop is to sell donuts and coffee. Whatever is income generated by selling this coffee and donut is the business income for the coffee shop and will be fully included in their taxable income. But if this same coffee shop sell their old furniture or old machine, because this selling of this old machine is not their main business, this will be treated as capital gain for this coffee shop. Now let's take another example of a factory which is selling machinery. When this factory sells machines to this coffee shop, because this selling machinery is their main business, whatever business income is generated will be treated as business income and will be fully included in taxable income for this factory. But this same factory, if they sell their old furniture, because this selling old furniture is not their business, it will be considered a capital gain for this factory. Now let's try to see how CRA and courts decide whether one income is capital gain or business income. There are a couple of factors that court and CRA consider. Major factors are primary intention of buying some asset, relationship with your business, and frequency of that transaction. For example, you buy inventory, so primary intention for buying this inventory is to resell, you do frequent transaction, and your holding period is very short. So these are all symptoms of business income. Another factor is secondary intention. Sometimes you may buy an asset with no immediate intention to sell it, but back of mind you have thinking that whenever there is a good opportunity, you will sell it and make profit. And this intention may lead CRA and court to decide that it is a business income, not a capital gain. Another important factor is additional work done on the property. Sometimes we buy a property and get additional work done to improve the property and make it more saleable and profitable. This would clearly indicate to the CRA that this intention was to resell the property, and CRA will treat this as a business income. Holding period of an asset is a very important factor in deciding whether income is a business income or capital gain. If you frequently buy and sell something or an asset, this clearly indicates that your intention is to sell and make profit, and it will be treated as business income. Whereas if you buy and hold some asset for a long period of time, this is a clear indication that this was not bought with the intention of reselling it, and it may be treated as capital gain. In the end, please note that whatever factors we have discussed, they will collectively decide whether one income is business income or capital gain. And final thing, because capital gain is treated separately in taxable income, So any capital gain can be offset with only capital loss. If you have capital loss and you have some other income in tax return, this capital loss will not reduce your other taxable income. I hope you found this video helpful. We have detailed article on this and other related tax topics on our website. We are leaving links of this article in the description. And finally, feel free to call Source Accounting Professional Corporation if you need any tax advice.